Good afternoon, friends. Under the personal tax planning, in this lecture, I'll be talking about tax deductions. If you recollect, in my previous lecture also, I talked about there are certain type of deductions which are allowed from your total income. So, if you invest or if you spend money under certain heads, then up to a particular limit, your total income will get reduced by that expenditure or by that investment which you have made, and your taxable liability will get reduced. So, I will continue with the various tax deductions that are allowed under the Income Tax Act. One section is called Section 80EE. What this section and what are the tax deductions that are allowed? Individual taxpayers are eligible for deduction under Section EE with the interest repayment of a loan taken by them to buy a residential property qualifying for deduction. The maximum deduction permissible under this section is rupees 3 lakh. Friends, the Government of India wants that people should have their own house. So, housing is a priority sector for the Government of India, and government wants to promote that people should make their own house and there should be a proper living standard of the people. So, since buying a house or construction of a house is an expensive affair, for that purpose many of us take loan from the banks or the financial institutions, and on that we pay the interest. Since the government wants to promote the housing sector, so what the government has done is that it allows, if you are paying interest on your housing loan, so up to a maximum limit of rupees 3 lakh rupees, that is deductible from your total income for the purpose of calculating taxable income. That is under Section 80EE. Any individual who has taken loan for the purpose of constructing the house or buying the house, and at that end the interest is being paid by the individual to the banks and the institutions. So, on this interest amount, I am not talking of the principal amount. Principal amount I have already talked about earlier in my previous lecture. I am now talking about the interest repayment. So, the interest that is being paid on that loan amount. So, on that interest, the interest portion, supposing I am paying 2 lakh rupees as an interest for my housing loan. So, this 2 lakh rupees is allowed as a deduction under Section 80EE for the purpose of calculating my taxable income. That is my total income minus 2 lakh rupees, that is the interest amount which I am paying on my housing loan, then my taxable liability will be calculated. This interest amount is subject to a maximum 3 lakh rupees. That is, any individual can claim deduction up to maximally 3 lakh rupees. That is, the person can claim up to 3 lakh rupees for the as deductible amount from the total income. Another section is called Section 80G. Section 80G encourages taxpayer to donate the funds to charitable institutions offering tax benefits on monetary donations. There are certain charitable institutions which are in the field of education, in the field of health, in the fields which are in the public interest. And if you give any donation to these charitable institutions which are listed charitable institutions under the Government of India, which are registered charitable institution, then you are also allowed to have a tax benefit for it. Means your taxable income will be get reduced by that amount up to a particular limit. So, all assessees are eligible for this deduction, subject to them providing proof of payment with a limit of deduction decided based on a few factors. Means there are different type of institutions. If you give donation to these institutions, the limit is being set by the government, right? So, means when I use the word government, means under the Income Tax Act. So, these deductions are allowed to of a various limits depending on the various factors. So, if you give donation to these institutions, that your taxable income will be get reduced. Your taxable income will be reduced by the amount which you pay depending on the ceiling fixed by the government. like for example, 100% deduction without any limit means there will be no limit. You can give any sum of money, you can give even 5 lakh, 10 lakh, 20 lakh, 50 lakh. Donation to funds like National Defence Fund, Prime Minister Relief Fund, National Illness Assistance Fund, etc. qualified for 100% deduction on the amount donated. I mean, when the pandemic took place in this country in the name of the corona, right? There was a illness all around, and for that the government of India was spending a very heavy amount. So Prime Minister started a fund that is called Prime Minister Relief Fund, under the Prime Minister Relief Fund. Or suppose there is any natural calamity that takes place on which the government of India has to spend very heavy amount. So at that time the government request its citizen to give some donation under the Prime Minister Relief Fund, so that from that fund the help can be extended to those citizens who are being affected. So if you donate under these funds, that is called National Defence Fund, these are only for example, Prime Minister Relief Fund, National Illness Assistance Fund, etc. Then whatever donations you give, 100% of this donation without any limit is allowed as a deduction from your income for the purpose of calculating taxable income. Suppose my income is 60 lakh rupees per year, not per month, per year. And in a particular year, I paid 20 lakh rupees in the Prime Minister Relief Fund, right? So my taxable income will be not 60 lakh rupees, but 40 lakh rupees. Because if I paid in the Prime Minister Relief Fund, if any individual pay under Prime Minister Relief Fund or National Illness Assistance Fund, right, or National Defence Fund, then there is no limit. 100% of the donation that is being given to under these heads, that will be deductible from your total income for the purpose of calculating taxable income. Then 100% deduction with qualifying limits. Previously there was no limit. Now there will be qualifying limit. There will be limit to the extent to which you can give the donation. Donation to local authorities, association or institution to promote family planning and development of sports qualify for 100% deduction subject to qualifying limit, right? Means if you give donation to some sports development fund or local authority or association or institutes, then there is no limit as such, but the qualifying limit is there. Means 100% is deducted, but up to a qualifying limit. 50% deduction without qualifying limit. Donation to funds like the Prime Minister Drought Relief Fund, Rajiv Gandhi Foundation, etc. are eligible for 50% deduction. Suppose I pay 20 lakh rupees, then 10 lakh rupees will be deducted from my total income for the purpose of calculating taxable income. 50% deduction with qualifying limit. Donation to religious organizations, local authorities for the purpose apart from family planning, and other charitable institutes are eligible for 50% deduction. Means if I pay 10 lakh rupees, 5 lakh rupees will be allowed. 50% deduction subject to certain qualifying limits. Means there will be limit in which I can donate under this fund. Under the previous head, there was no limit. The qualifying limit refers to 10% of the adjusted gross total income of the taxpayer. When I use the word adjusted gross total income, right, it means, as I said earlier in some context, it includes my salary, my basic pay, my HRA, my DA, plus other commissions if I am getting. So there is a limit. 10% of my income can be donated in, and 50% of it will be eligible for tax deduction. Tax deduction under Section 80QQ(b) is this section allows a deduction. So under Section 80QQ(b) permits tax deduction on royalty earned from the sale of books. You are an author, right? You are writing books which are of literary nature, which are of scientific nature, right? Which are of artistic nature. Then the royalty which you receive up to a particular limit, and that limit is 3 lakh rupees. Then this royalty is deducted from your total income for the purpose of calculating taxable income. That is, under this section, only resident Indians, those who are living in India, resident Indians, authors are eligible to claim deduction under this section with the maximum limit of 3 lakh rupees. Royalty on literary, artistic and scientific books are eligible for tax deduction. That is, what it means is, if you write a textbook, right, which is prescribed in a particular syllabus and is of purely a textbook nature, that will not be allowed, right. So if you are writing a diary, your own diary, and you get it published, right, so these diaries which you get it published from some publisher, that is not allowed. So only those books, if you are getting royalty by writing some scientific books, by some literary work, some art related work, right, then only your royalty which you receive up to a maximum ceiling of 3 lakh rupees is allowed to be deducted from your total income under this head, section 80 QQB, right. So these books are not allowed, which I have already explained. Should be from abroad. If you are getting income from abroad, so in case of author getting royalties from abroad, the said amount should be brought into the country within a specified period in order to avail tax benefits. Suppose I am a resident Indian and write books in India of a literary nature, of some scientific nature, and I am getting some royalty from outside. The book is being sent through various channels outside India also, and I am getting royalty from it. So the royalty must be, I should get it back in India, and up to a particular limit, means within the time span I must get it in India, then only I am eligible for this benefit under this section. There is another section called section 80RRB. Under section 80RRB, the tax incentive to patent holders, providing the tax relief to resident individuals who receive an income by means of royalty on their patents. Royalty to the tune of rupees 3 lakh can be claimed as deduction, subject to the patent being registered after 31st March 2003. A large number of people outside India also, they make something and get the product patented, and for that patent they get royalty. Indian government also wants that Indian people should be more innovative. They get their product or services patented, and this patent, if you are getting your patent after 31st March 2003, then up to a limit of rupees 3 lakh rupees, the royalty which you receive, the money which you receive on your patent, you get your patent registered, and your patent is giving you income of royalty income up to 3 lakh rupees. So this 3 lakh rupees is deducted from your total income for the purpose of calculating taxable income. Like royalty, received on the writing of books of scientific nature, literary nature, right? Similarly, the royalty received on patent is also eligible for deduction of tax, providedly you get your patent registered, you have got your patent registered after March 2003, that is 31st March 2003, and the maximum limit allowed is 3 lakh rupees. It doesn't mean if I am getting 1 lakh rupees, then I can claim a deduction of 3 lakh rupees. It is a maximum limit. If I am getting 1 lakh, my taxable income will get reduced by 1 lakh only. So individuals who receive royalty from foreign shores, that is outside India, need to bring said amount to the country within a specified time period in order to be eligible for tax deduction under this head. That is the way royalty on books, if you are receiving outside India. Similarly, if you are receiving royalty on patents from abroad, outside India, then you must bring it back to India. Your income must be brought to India within a time span, right? Then only you will be eligible for deduction under this section. There is another section called section 80TTA. Friends, when I am talking of these sections, you must be very clear that there are various sections of Income Tax Act under which these deductions are permissible, depending on in which head you are eligible. These deductions you must know for better tax planning. So, if you are getting income under you're getting, say for example, you're getting royalty, and if you're not aware that this royalty which you're receiving, Government of India has allowed you a special deduction that for the purpose of calculating tax, this is allowed so that the tax liability get reduced. So suppose I'm an author, I'm a lecturer, I'm a teacher, right? And I'm getting salary income and I'm also getting royalty income, right? So if I do not know that if I'm writing a scientific book and the royalty which I receive under the this section, that is allow me to get the tax deduction, I may be end up with paying tax on my total income, whereby if I make proper tax planning, I am eligible to get deduction up to the 3 lakh rupees for the royalty which I am receiving for writing the book, right? So for each individual, it is important to know that what the right tax liability is, so that proper tax planning can be made, so that proper financial planning can be made. So there is another deduction under section 80TTA. Deduction under section 80TTA can be claimed by Hindu undivided families and individual taxpayers. Our focus is here on individual taxpayers. So this section permits deduction to the tune of rupees 10,000 every year on interest on money invested in bank saving account in the country. Most of us keep money in our banks, and especially for saving banks, so that saving account, so that any time any need arise, we can issue a check or we can withdraw from the bank for incurring day-to-day expenses. And the bank pays a minimum, is a fixed amount of interest on the balance which we have in our bank account. So the interest earned on our saving bank or in our fixed deposits up to a maximum limit of 10,000 rupees. This is in form of interest, not the principal amount that we have deposited in the banks, right? So if you earn interest up to 10,000 rupees in a particular year, that is deductible from your total income for the purpose of tax liability, right? So up to 10,000 rupees interest which you are earning, it is not taxable. Deduction under section 80U. Tax deduction under section 80U can be claimed only by resident individual taxpayers who have disabilities. Friends, earlier when we talked about section 80DD, if you recollect, basically that was on dependent children or your siblings, that is children, or your spouse or your parents, right? Here we are talking of self. Section 80U deals with the self. If suppose an individual who is earning and he is disabled, or if she is disabled, then under section 80U there is a deduction that is allowed. So this section tax deduction under section 80U can be claimed by resident individual taxpayer who has disability, means for self. Individuals who have been certified by relevant medical authorities to be a person with disability can claim a maximum deduction of 70,000 rupees per year. Who have severe disability, this limit is 1.25 lakh rupees. Means up to 80% of disability, this is 75,000 rupees. If the disability is more than 80%, which we call it severe disability, this is limit is 1.25 lakh rupees. Friends, I am repeating, this is apart from 80DD, which allows an individual to claim deduction for the dependent children or parents or spouse. This is for self. If a person who is filing the tax return, who is assessing himself, right, in a particular financial year, if you're a person with disability, normal disability or severe disability, then this deduction of 75,000 rupees or 1.25 lakh rupees will be allowed by the income tax authorities. Your total income, your taxable income will get reduced from your total income by this amount, that is 75,000 or 1.25 lakh rupees, depending on the abilities, depending on your eligibility, right? So there are certain type of disabilities like Oystein, mental retardation, cerebral palsy, etc. Under section 80U, these type of disabilities are permissible. Another section called section 80GG. Section 80GG allows you to reduce your tax liability for paying house rent in case you are not get HRA. House rent allowance, HRA means house rent. To claim HRA, to claim this, you must not own a house in the name of yourself or your spouse or your children or a member of HUF in the place of employment. You must also live in rented accommodation and pay regular rent, right? So under 80GG, those people, those who are not getting HRA, suppose a salaried employee, he is getting or she is getting house rent allowance. But if you are an individual, you are a professional, you are working, you are a doctor, you are a lawyer, and you are paying house rent, you are not having your own house and you are paying house rent, then you are also allowed to have some tax benefit. You can claim the least of the following amounts as a deduction. Rupees 5,000 per month, rent paid over 10% of the income. Whatever you pay, more than 10% of your income. If your income is say 50,000 rupees per month and you are paying 12,000 rupees as rent, so then 7,000 rupees, because 50,000's 10% comes to be 5,000 rupees and you are paying 12,000 rupees. So 7,000 is you're more paying than your 10% income, or 25% of your income. 25% of your income comes to be 12,500. So least of these is 5,000, right? So I mean, whatever the limit, whatever the minimum of these three is, either 5,000 per month or rent paid over 10%. Rent paid means actual rent paid of 10% of your income. In this case, if your income is 50,000 rupees and you are paying 12,000 rupees, it means 7,000 extra you are paying over and above your 10% of income. So in this case, and 25% comes to be 12,500. In this case, 5,000 will be permissible only. Section 80GG. Under this subsection, an individual taxpayer can claim tax deduction, benefits, or any contribution or donation made to a political party or electoral trust. The contribution cannot be made in cash, that is, you have to pay in the form of digital payment or in check. Any local authority or judicial person is not eligible for a tax deduction, right? Means political donation paid to by the individual, that is also allowed under this section. So friends, in this lecture I have talked about the various sections of the Income Tax Act, under which if you make investment or if you spend money, right, you make expenditure under these various heads which we have discussed in this very lecture, your taxable liability will get reduced because you are eligible to get deduction from your total income for the purpose of calculating taxable income. So with these words, thank you very much for today's lecture. Thank you.